Where to put your money after the Fed drops interest rates. Hey everyone, it's Wolfgang. So this is an imminent change that's going to happen. The Fed, seeing the poor jobs data, will lower interest rates in the upcoming days. The Fed will start lowering rates because of poor U.S. jobs data. Lower rates will affect short-term investing. So we're all used to 4% or better rates of return, risk-free, no market risk. That's changing. 3% rate of return is coming. So a lot of us have over 4% rates of return in risk-free investments, inflation-beating investments, money on the sideline. You know, it's emergency savings, business, money set aside for business, working capital is earning over 4% for a lot of us, right? So that's going to change. So let's think about short-term versus long-term changes. If you purchased treasuries, U.S. treasuries, that rate of return will hold. It's not going to change overnight just because the Fed changes interest rates. If you've already purchased U.S. treasuries, that rate of return is good until the U.S. Treasury matures, right? So you don't have too much to worry about until you have to roll that money over into new treasuries. Money markets, not all the time, but often money markets will not show any change for 30 days, okay? So this is really long-term. If you purchase U.S. treasuries in the past and you still hold them, nothing's going to change. That's long-term. Money markets, usually 30 days. That's getting kind of short. If you have cash in premier savings accounts at banks, that will often change immediately. So that's long-term all the way to short-term. So what can you do to redeploy that money? Obviously, you would like to earn better than inflation rate of return on your cash. This is talking about the part of your investment portfolio that is cash-based. It may be in money markets. It may be in premier savings and banks earning over 4%. It may be in treasuries, but generally it's cash. It can be converted to cash very quickly. That's kind of what we're talking about. So we've got an issue here we've got to think about. Where can we deploy this, the money that we've set aside that is cash or cash equivalent? So I'm going to explain some options. First, before we do that, let's compare the U.S. Interest rates to the rest of the world. We're a little bit behind the eight ball in terms of lowering interest rates. The EU zone is down at 2.15% interest rates, 2.15%. So this change they've had to make, putting their short-term cash or cash equivalents into something else, they've already had to tackle that because they're already down at 2.15%. Japan is less than 1% interest rates in Japan, 0.5%. Canada is at 2.75% right now. Australia, a little closer to the U.S., 3.6%. But all these folks are well below 4%, right? The U.S. is at 4.5%. So if you have working capital for your business or cash you set aside, emergency cash that you've used to buy treasuries with, because there is a secondary market. There are two markets for treasuries. There's an auction and there's a secondary market. So if you need to sell your treasuries, you can sell them immediately in the secondary market and raise cash. Premier savings in banks, you can convert that to cash very quickly. There is a lot of money. We're in a big boat here. There's a lot of money in this low-risk environment. There's over $7 trillion in U.S. money earning 4% or better right now, 4% or better. 7 trillion is a record. That's a huge number. That's a lot of people like us who have put our money into these various assets. Me personally, I've got all of these, and one that I forgot to list, which is certificate of deposit at banks. So that is more medium term because that yield will not change during the life of the CD. So there's over 7. I think it's like $7.5 trillion US that is in these sorts of accounts. And until now, there's been no market risk. But I'm telling you what's going to happen when rates start dropping towards the 3% range. An increasing number of people will say, I don't want 3%. I want a better return than that. And they will start redeploying that 7 trillion. It won't happen overnight. It won't happen to everyone. And it will happen gradually as the rates come down to 3.6%, then 2.75%, 2. They'll never get that low probably. But as the rates drop, people will say, enough, I need a rate of return. Where will the $7 trillion go? Okay, so if you think back to just a few years, remember the acronym TINA. there is no alternative, right? There is no alternative. Stocks was the only choice to get any sort of rate of return. Between 2008 and 2021, the Fed had zero interest rate policy. ZIRP, zero interest rate policy. It was like Japan is now. There was no way to earn a decent rate of return from these vehicles, from treasuries, from money markets, from CDs, from premier savings accounts. They did not offer 4% or better rates of return. There is no alternative. This was true for over a decade, right? 13, 14 years. It changed towards the end of 2022 when the Fed started increasing interest rates because inflation spiked to like over 9% in the US. Okay, so the Fed had imposed zero interest rate policy, and that triggered this sort of outflow from these sorts of investments, treasuries, money markets, CDs, premier savings. And that's what's going to happen again. People are going to say, I need to redeploy these assets into something to earn a return. Like if you need working capital for your business, you don't want to put that in just a regular savings account where you're making 0.01%, right? So savings rates become less attractive when this kind of thing starts happening. When the Fed starts lowering rates, which is what they're going to do, you're going to have to figure out where to put your capital. So here are some ideas. I couldn't fit everything on the board here. There are ETFs that offer dividend-paying stocks. They provide income, and you can get growth in your investment in these ETFs. I'll give you some examples. Okay, these are just examples. I'm not a financial planner. I'm not a financial advisor, but these are in the marketplace now that you might want to think about. Vanguard Dividend Appreciation ETF. Ticker symbol is VIG. The Spider Portfolio S&P 500 High Dividend ETF. The ticker symbol is SPYD. Another one is iShares Select Dividend ETF. Ticker symbol DVY. You should ask your financial planner. You should say, I want to create a plan to start rolling my business's working capital, my personal emergency cash out of these investments and into something that will, unfortunately, face a little more market risk than we're used to. I mean, once we get down to these levels of interest rate, you will be looking for better returns. You will become willing to, to sort of do what we did 2008 to 2021. There is no alternative. Invest in stocks or ETFs, dividend-paying ETFs. If you still want, somewhat cash equivalent investments, those are some options. Those ETFs are some options. Ask your financial planner, obviously, if those are right for you. But the thing you want to think about also is, what is your income earning potential? If you're retired, right, you really want to pay attention to making any changes in this kind of stuff. Because, if you're not earning, if you have zero earnings because you're retired, then your profile is a little bit different from someone who is in their 30s and still has a lot of their career left, and they may be able to take on more risk. When you're retired with no income, you have to be a little more cautious. You might want to become a little more cautious. So that's why you should talk to financial planner, your financial advisor, on what to do. Whether those ETFs are right for you or not will depend. But I will tell you what we do. We will gradually roll portions of our, the assets we have deployed in these vehicles out into dividend-paying assets, into assets that pay dividends, that hold stocks that pay dividends. If you're still earning an income, you have the option to take a little more risk, market-facing. But the bottom line is, there is no alternative. What that meant was, if you want to get any rate of return, you're going to have to face market risk. You'll have to buy stocks. So that's what happened when the Fed lowered interest rates quite a bit. We're not going to get there this time. Hopefully not, right? Because we're just at 4.5% now. Probably by the end of this year, we'll be at 4% or maybe a little less. So you have to start thinking about this. Redeploying incrementally. Have a plan over the course of a year. I will redeploy 25%, then another 25%, then another 25% into these cash equivalents that have some rate of return. Because if you were in Japan, would you be putting your money into bank accounts? No, right? You would be a Tina sort of person. There is no alternative. You'd be invested more in market-facing risk. If you think about Warren Buffett in his 90s, he just recently started pulling back. Through his age 95, he was still earning an income, taking full-on risk, taking a lot of risk. So that's one argument for trying to figure out a way to keep at least a portion of your career going and earning some sort of income so that you feel a little bit better about taking on some market risk. But you definitely want to talk to a professional, money manager, a financial planner, an advisor for your family about what to do, because this is coming. 3% rate of return is coming. So if you have any questions about this, I can dig into details a little bit if you'd like. If you have any questions, please post in the comments. I'd be happy to answer any questions you have. I really want to thank everyone for watching. Have a great day.